So in terms of the first key theme, I would say is the strength of the mega cap 7 stocks. And it's really interesting that this level of concentration in terms of narrowness of stock market performance really hasn't been seen since the 1970s. And so you've got these 7 stocks which have driven all of the positive gains for the S&P 500 year to date, and the other 493 stocks are actually flat to negative. And so that breadth is incredibly narrow. Secondly, I would say the generative AI theme is also really stands out this year. And for the first 2 quarters of the year, we really saw this excitement and great share price performances from stocks linked to generative AI, and that's also manifested in the mega cap 7 as well, and why they've done so well this year. And thirdly, I would say from a geographic perspective, the US certainly stands out as the most resilient economy. And on the other hand of the spectrum, Europe is really in a bit of a fragile state at the moment. So basically, in the first half of this year, we certainly saw equity markets rise quite strongly. And that was exactly on this theme of narrative that a US soft landing is the base case scenario, and that was being priced in. But in the third quarter of this year, we've seen markets sell off a bit in the US on that soft landing probability reducing slightly. So from here, there's really 3 scenarios that are possible. So first is a no landing scenario, and that's where growth basically continues to accelerate. And that's possible from firstly generative AI and the productivity benefits that can imbue on the economy. And secondly, also on this trifecta of spending acts that the US has brought in with the Infrastructure and Jobs Act, the CHIPS Act, and the Inflation Reduction Act. And that unleashes about $2 trillion worth into the economy, and that can help sustain growth for longer. The second scenario is a soft landing scenario, which is really the Goldilocks scenario. And that's really what the Fed is forecasting at the moment. So that's for inflation to gradually slow to around the 2% mark, and for unemployment rate to stay roughly flat. And the third scenario is a recession scenario, which could happen in 2024 to 2025 sometime. And that could really be driven by this record fast-paced tightening by the Fed. So this is the quickest Fed tightening campaign since the 1980s. To increase the Fed funds rate by over 500 basis points in 18 months is really quite quick, and it takes time for that to flow through to the real economy and to decrease demand and cause recession ultimately. And if you look at history, there's been no time in the past where the Fed has hiked this much without causing recession. And if you look at the last 9 rate hiking cycles, there's only 2 that haven't resulted in a recession. And that was when the Fed funds rate was only increased by about 300 basis points, and coming from an environment of low inflation. The first one would be the earnings forecast for the US stock market as a whole seem to be quite optimistic. So the market's forecasting about 12% EPS growth for 2024. And in terms of the third quarter earnings result that we're going through right now, it's really becoming clear that the earnings outlook and guidance from companies are being tempered, and there's a bit more cautiousness there that we haven't seen for a few quarters before. And I would also say, we're seeing negative earnings revisions starting to flow through as well. So something to be aware of. Secondly, the other risk would be around the US consumer, where we are starting to see signs of a weakening in their position. And that's driven by a combination of auto loan delinquencies reaching a new cycle high. Secondly, you've got their COVID savings buffers are pretty much all run out. And thirdly, credit card balances are at record highs, so showing that they're relying on that to maintain their spending patterns. the other theme I would talk about is the US industrial renaissance that's happening at the moment. And there's really a trifecta of spending acts that were passed in the last 2 years, being the Infrastructure and Jobs Act, the CHIPS and Science Act, and also the Inflation Reduction Act. And when you combine these 3 acts together, they actually inject about $2 trillion worth of funds into the economy over the coming years. And so what that really does is, it's ushering in a new era of mega projects in the United States. And so there's a lot of reshoring that's happening, factories coming back to America, and a whole lot of non-residential construction activity that's happening right now as we speak, and that's set to accelerate. And so at Northcape, whilst we aren't macro investors, we're bottom-up fundamental investors, we are cognizant of the range of outcomes possible and try and position the portfolio for a range of macroeconomic outcomes.